Well, welcome everyone to the first Mortgage Quality and Compliance Committee webinar for 2021, hosted by the California MBA. I'm Susan Milazzo. I'm the CEO of the California MBA, and I'm very happy that you can join us this year. We are very happy to introduce our chair and co-chair for this year's committee. Our chair, he couldn't be with us today, but I know that he will be next month, is Raymond Schneitzeble, Chief Operating Officer at First Line Compliance. And with us today is our co-chair, Paula Lieber, who is the Chief Compliance Officer and Licensing Specialist at CMG Financial. So Paula, would you like to share some opening remarks with our guests today?
Yes, thank you, Susan. Welcome everybody to our first webinar of 2021. Very excited for the new year. And I'm Paula Lieber. I'm actually Vice President of Compliance and Licensing. I appreciate the promotion, Susan, but please CMG. And I was very excited to serve as co-chair of the committee this year. I'm really excited. We definitely have quite the year ahead of us. We've got a lot of changes in our political landscape that are going to affect us. And these webinars are fantastic to keep up to date on everything that's going on. So definitely recommend, forward it to other people. It's going to really help you this year. And Susan, I'll turn it back to you.
Great, thank you. So for those of you who might be new, I will let you know that we do this on a monthly basis. It's always the fourth Thursday of the month at 11 Pacific. And we feature a different compliance topic, of course, each month. And if you had this, as Paula had said, if this email invitation to join today was forwarded to you and you'd like to be added to our distribution list, you can email me, susan@cmba.com. I'll make sure that you get these directly sent to you in the future. So I can't advance my next slide though. I don't know why that's doing that. Give me just one moment. Apologies for that. So our agenda today, we start off with a legislative update from our lobbyist, Pat Zenzla, who's we're just a few weeks into the legislative session this year, but there's at least one bill that Pat's going to talk about. And if you join us in future months as we get more into the legislative session, we'll be talking about a couple of the bills that are of most significant interest to the mortgage industry here in California. So with that, Pat, I think we'll go ahead and turn it over to you, and you can talk with us about SB 91.
Thank you, Susan. And starting out, as Susan mentioned, we're very early in the legislative session, just a few weeks in. We've probably had several hundred bills introduced at this point. The bill I want to talk about today, I think, is of great interest to us, primarily because of the efforts that we fought last year to avoid kind of overreaching forbearance and foreclosure mandates or restrictions. This bill, SB 91, is considered to be a budget bill by the legislature, and what they're trying to do is to extend out the protections that were put in place primarily for tenant rent relief and landlord relief from 2020. They were set to expire at the end of January, and they're extending those protections out until the end of June, so another 6 months. Also providing some financial assistance to both tenants and landlords that are in need of it. The reason why I'm bringing it up today is because in the bill that passed last year that put these in effect, there was also some mortgage-related provisions on the residential side. And what this bill does is it would extend out those protections also. They were set to sunset on April 1st of 2021. And they're going to be extended out until September 1st of 2021. And just as a reminder, they were some very kind of logical requirements as far as protections that were put in place by this bill and were not problematic from an industry perspective. Here are a couple of the examples of what they put in place. If a servicer denies forbearance request made during the effective time period, so in this case it would be through September 1st, the servicer would provide written notice to the borrower explaining the reason for the denial. And if the servicer identifies that there was a curable defect in the borrower's forbearance request, have to let the borrower know about that and provide 21 days to cure that defect. And then finally, if there's a forbearance denial that is maintained, so you don't provide any assistance, you would then provide it in the disclosures, the notices that are already required for the civil code today, as far as trying to interact with a consumer prior to foreclosure to look for ways to avoid the foreclosure. And then the other thing I just want to mention is there is a safe harbor in these provisions that say for federally backed and for non-federally backed mortgages, if a servicer complies with the CARES Act or if the federal agency guidance, then you do not have to comply with the requirements in the state law. So a lot of protections in there, and quite literally the legislature is reviewing this bill as we speak. The Assembly just passed it and it's sent over to the Senate, and they expect to vote on it probably within the next hour. And if the governor signs it, it would take effect immediately. So Susan, that's I think the main thing I wanted to talk about today.
Thank you. Thanks, Pat. And so essentially, this hasn't implemented anything new. It's just extending the deadline that was established last year.
With respect to mortgages, that's the case. For rent relief and some protections there, they do create some new requirements, but not on the mortgage side.
Okay, great. Well, we will continue to monitor this for sure. Thank you very much, Pat, for being with us today. We'll go ahead and start our presentation for this month, which of course is talking about the new qualified mortgage. I'd like to introduce our two speakers. We have Joe Lynyak, who is a partner with Dorsey and Whitney. He has been around the California MBA for many, many years and has played a pivotal role in many of our legislative and legal issues for many years, and provides consulting and focuses his practice on in banking, non-banks, and in the financial services industry. And we've been very grateful to have Joe as such an active member of our association for all these years. Also presenting is Angela Cheek, who is Vice President and Counsel of Product Compliance at ICE Mortgage Technologies, formerly Ellie Mae. She leads the team as responsible for implementing and maintaining automated residential mortgage lending compliance in ICE Mortgage Technologies software applications and systems. For more than 28 years, she's focused her career on operations, lending, real estate, and business law, working primarily with financial institutions, mortgage lenders, and technology companies. So with that, and I know that Joe and Angela have known each other for a number of years, so that always makes for a fun presentation when there is some history there. So Joe, we'll go ahead and kick it off with you and take it away.
Oh, well, thank you very, very much, Susan. Yes, Angela and I have known each other for about 150 years. What we're going to try to do in terms of the GSE Patch is talk about what is effectively a sordid history about the background of the patch, review quickly the interface between the patch and Regulation Z's ability to repay rule and requirement, talk about the death of Appendix Q. Yes, that's right. Yes, keep clapping on that one. The revised QM definitions and alternatives that you can consider. Then at that point, Angela is going to talk about her perspective from her company's viewpoint and the services they offer. And then we're going to end up with actually some very, very good news, may have been unintended in terms of the way the regulation was written, but it's good news, I think, for everybody on the line here, answering the question, was all of this nonsense really worth it at the end of the day? As next slide, please. As background, in December, probably on the way out of the door on the Trump administration, the CFPB published its resolution to the expiration of the so-called GSE patch, and it's effective on March 1st, 2021, and we're going to talk about that a little bit as well down the line. And the GSE patch was supposed to expire earlier, so they also had a companion regulation which said that the GSE patch will not expire until the new definition of what a QM qualified mortgage is. And so they basically combined them, and that was actually a good thing. Regarding the history surrounding the patch, and next slide, please. It was created to be an exception to the requirement in Appendix Q of Regulation Z, the dreaded Appendix Q, that a loan qualified for QM status only if the debt to income ratio was 43% or lower. And that certainly made everybody crazy, because it would eliminate people from qualifying for residential mortgage loans. And yet at the same time, this was put in place under Dodd-Frank, and Dodd-Frank was, oh my God, we made, somebody bought a toaster, they got a house, and the qualifications and underwriting standards had effectively, at least in terms of the Obama administration, had gone out the window. We had the mortgage crisis, and we would never let that happen again. But at the same time, as they were putting in place what they thought were very, very stringent requirements, including the ATI requirement, they realized this may not work too well. What can we do? Well, simultaneously, the default rates for Fannie and Freddie loans were much, much lower than that in the industry in the subprime area. And so what they said is that they were going to create a conclusive presumption of QM status if a mortgage loan was approved for purchase by one of the GSE underwriting engines, loan prospector or desktop underwriter, regardless of whether or not you eventually decide to sell it to the GSEs. And what happened as a result of that is that the GSE patch and the use of the GSE patch and the use of the underwriting engines became the primary underwriting tool for the residential mortgage industry. Almost immediately, no secondary market in non-QM loans resulted in that there was simply nothing sold in the secondary market, and we'll get to that in a moment. And non-QM loans, also including jumbo loans, became the province of portfolio lenders. But if you didn't make a QM loan, you couldn't sell it in the secondary market, and that resulted in the sales to Fannie and Freddie dominating the secondary market, and that was where the action was. Now, that would the QM patch was set to expire. And the next slide, please. For some reason only known to economists, the FHFA, which at that point was probably dominated by the Trump administration crazies, and the MBA, they just simply hated the patch. You could not talk to them about it. And while I am very, very good friends with the MBA and all the great work that they do, this one got away from them, and they just hated it. They did not want it. They did not want it to continue. And the two of them, the FHFA and the MBA, combining forces, it was a formidable opposition to continuing the GSE patch as we knew it. And so the CFPB proposed a rule which had several alternatives, some of which were all right, some of which were just simply unworkable. But it was very, very clear from reading it that the GSE patch as we knew it was a dead duck. And this is besides the fact that, as a practical matter, incorporating the underwriting engines into a lender's, whether it be a bank lender or a non-bank lender, was very, very easy to do. And there was a conclusive presumption that once you got the notice that yes, we will, one of the GSEs, Fannie or Freddie, would buy this loan, you had a conclusive presumption that this was a QM, and you could then proceed to originate the loan, because if you didn't have it, nobody was going to buy it. Next slide. And it's important to understand the interface with Regulation Z's ability to repay rule and what constitutes a QM. The ability to repay rule implements sections 1411 and 1412 of Dodd-Frank. If you do not underwrite a loan indicating a borrower's ability to repay, the penalty for originating that loan is death and boiling in oil, and that within a 3-year period, you would have to turn back over to the borrower all finance charges and just about every other fee and charge relating to the loan, which means that nobody would buy one of these things because we don't want to take the chance buying it. The liability is just too high. And the result is, as I mentioned before, is that there was no market in non-QM loans. But if you had that little certificate from Fannie or Freddie saying, yes, under our underwriting standards, we would buy the loan, you had a safe harbor and you could proceed. Now, the underwriting factors under the ability to repay rule are, I believe there's 8 of them, and they have to be considered and verified in your underwriting standards. Current or reasonably expected income or assets, current employment status, the proposed monthly payment for the covered transaction, the one that you're actually underwriting, monthly payment on any simultaneous loan that may be out there, monthly payment for, so a simultaneous loan would be a trailer second, monthly payment for other mortgage-related obligations. So, for example, you might have a HELOC involved, or you may have other mortgage transactions that you'd have to worry about. Debt obligations, alimony, child support payments, but importantly, the monthly DTI ratio, residual income, and credit history. And so the DTI, again, you look towards regulation, Appendix Q, or you did the underwriting engines. Now, again, I will just digress for a moment. There were QM definitions for FHA, VA, and so forth, but those were, niche markets as opposed to the larger residential market, and that is in which people utilized the GSE patch in order to move forward. Now, let's talk about the death of Appendix Q. This is not going to be a eulogy. Good riddance to Appendix Q. Nobody liked it. Nobody wanted to use it. It was almost impossible to understand. It required a quant or some really esoteric nerd to be able to even explain what was in there. And then in addition to that, assuming the fact you wanted to use it, you had to come up with your own underwriting engine and your underwriting policies and procedures. And you did not get an automatic safe harbor, because somebody could then turn around and say, well, I understand that you used Appendix Q, but you didn't do it properly. And therefore, you didn't get the automatic safe harbor. Someone could theoretically challenge you and say, what you did was a nice try, but it doesn't work because you didn't do it properly. And so in addition to that, in terms of consumer groups were always concerned about the fact that the 43% DTI would eliminate folks from being able to get mortgage loans. And so now we get to what finally happened in December. Next slide, please. The final rule states that QM status is satisfied. And again, instead of talking about what's in regulation Appendix Q, it goes to a pricing methodology. If the first lien mortgage loan is no greater than 2.25 percentage points or 225 basis points above the loan's APOR, you've got a QM. Now, it's important to note here that your policies and procedures must continue to consider all of those components for ability to repay, including the DTI. But what you don't have to do is set a 43% ceiling in order to achieve QM status. Now, as you all know, the APOR, which stands for the average prime offer rate, is a survey-based estimate done by the GSEs and others of the annual percentage rates currently being offered on prime mortgage loans. Now, the CFPB, being the crazy entity that it is, it can't just do something simply. It's got to do something a little more complicated. And what they did is they decided to bifurcate QM status and say, if you are no higher than 225 basis points above the APOR, you get a rebuttable presumption of QM status. But if you stay at 1.5% or below for the APOR, you get a conclusive presumption of QM status. And we're going to talk about that a little bit later about how the market is going to receive those two things. But so you've got a twofold issue, but as long as you stay below 2.25 percentage points and you've adopted policies and procedures, you're going to be all right. Now, what else did the crazy CFPB do? Next slide. Well, what they sometimes do is, it's the old acronym, a bunch of guys sitting around a table. It's like, we got to make sure that we don't allow these people to do something improper to consumers, which is certainly not what the mortgage industry wants to do. And then they put something in pretty quirky, and that is for loans with a initial adjustment period of 5 years or less. So that includes loans with a 5-year first adjustment. So you've got to go above 5 years. It requires that the lender must use the maximum possible APR in the loan documents during the 5-year period in order to qualify for QM status. Now, what is the effect of that? Well, the effect of that is that in terms of points and fees and all those other things that you've got to add up in the APR in order to determine whether or not you are above or below you're above the APOR, either 1.5% or 2.25%, you're probably going to be kicked up into the 2.25% number. And how that is going to be affected by the secondary market, we're going to talk about. This is probably something that eventually may have to be revisited. I would say it's stupid. But then again, I say that a lot when it comes to the CFPB. Now, before I turn it over to Angela, let's talk about, in the next slide, the seasoned loan exemption. And this is, frankly, it's nice. I think it's pretty stupid. It's a solution looking for a problem. But what is it? Well, the CFP published about 200 pages for a seasoned loan exemption that in Regulation Z is a page and a half, but they can't say anything for under 200 pages of gobbledygook, which is the way that they write. But it creates a new seasoned loan, which is a loan secured by a first lien, which has a fixed rate with regular, substantially equal periodic payments. The loan term does not exceed 30 years. Total points and fees may not exceed the normal QM limits, but while you have to consider the DTI, you don't have to impose a 43% DTI in order to qualify for an ATR. And the seasoning period is that it's got to be held in your portfolio for 36 months. There are limitations of being able to transfer or sell a loan during the seasoning period. And strangely, if there are a number of defaults, that then throws it outside of the seasoning loan exemption. And since you have no control over it, you have no control over whether or not it really is or is not a QM loan based upon this exemption. And since the statute of limitations for a ATR claim is 36 months, since you have to hold a loan for 36 months in your portfolio, why have we done this? I don't really know, but it's nice to have it there, and it's nice to talk about. And it's another dumb thing that the CFPB did in their crusade to help everybody and to avoid these perceived problems. But having
I was gonna ask you, Joe, because I tend to agree with you. When I looked at this new requirement for season, a new season loan qualified mortgage, I was wondering who was behind this push. I mean, do you know? Do you have an idea who thought that this would really help the industry or consumers? I can't understand. I'm not exactly sure why this made the cut of new type of QM versus some other form or version of QM. So I don't know if you have any insight into that, but I agree with you. I look at these new requirements for the season QM, and I'm not exactly sure. Like you said, it's a solution looking for a problem. I'm not exactly sure why this was done. Thoughts?
Well, let's see. I think we can also talk about this a little bit later when we talk about litigation potential. But I would say the reason why it was put in here is that the CFPB needs adult supervision as opposed to people, again, sitting around a table and doing things that are questionable. But let's go to your thoughts, and then we can come back to this in a little bit.
Okay.
Yes, thank you. So we'll turn it over to Angela. And for those of you that would like to ask questions, I encourage you to post those in the questions dialog box on the menu bar, and we can get to those at the conclusion of the presentation. So Angela, I will turn it over to you.
Okay, thanks. So Susan, are you going to forward it for me, or did you want me to do it?
No, I will do it.
Cool. Next slide. So now that Ellie Mae is a part of ICE Mortgage Technology, well, a part of ICE, and so we are now going to be ICE Mortgage Technology. We're a part of a publicly traded company again. So in presentations like this, I need to present the slide to all of you because I am going to be talking about features and functionality that may be placed into Encompass and Mavent software and services. And when I talk about that, those are forward-looking statements. It's defined by the SEC. And so normally I would somehow have to get a hold of you and let you know if we made any changes to these statements that I'm making that are forward-looking. And I'm just letting you know I have no obligation to contact all of you if we change our mind and make different changes or other changes into the system. Next slide, please. So building off of what Joe spoke about, I wanted to talk about automating these updates into your workflow and your origination process. At ICE Mortgage Technology, our North Star is to automate everything that is automatable in the residential mortgage loan industry. And of course, the ability to repay qualified mortgage rules, just are calling out and beg to be automated because of all of the thresholds and the data needed to arrive at the determination of whether the loan has met the requirements for the ATR standard or general qualified mortgage, patch, season QM, et cetera. With the rules that were just promulgated in December, there are three areas that were impacted and require some update to automation. One is the sunset of the GSE qualified mortgage loan patch, which has although the compliance date is March 1st, at least currently it's March 1st, the mandatory effective compliance date is for all applications received on or after July 1st of this year. General qualified mortgage, which is really interesting, that's the area I think of greatest impact where the new APR calculation for ARM and separate loans is created, which is, I think, going to have quite a large impact on the general qualified mortgage loan area, as well as the new price-based limits that Joe talked about, the removal of the hard and fast 43% DTI for general qualified mortgage loans, as well as the removal of Appendix Q. And then we have the season QMs, which are really interesting, and I'm sure Joe and I are going to talk about it here shortly. And those also have a effective date of March 1st. However, all three of these have a mandatory compliance date of July 1st of this year. Next slide. there we go. So to tackle the sunsetting of the GSE temporary patch, depending on your loan origination system, depending on the systems you use to originate mortgage loans, I'm sure that they are going to be updated to make sure that the choices of the GSE patch are removed and that you are left with the choices of general qualified mortgage, as well as the agency QMs, if you're originating an agency loan, an FHA QM, USDA RHS, or a VA QM. For purposes of any automated compliance engine you might use, and certainly for purposes of the Maven system, we're going to put in guardrails for you so that if any lender submits a loan with an application date on or after July 1st, and they want the system to run a test for a GSE QM type, they're going to get an error message. You're going to get an error message, and it's going to say, hey, you can't make these types of loans anymore. There's no such thing as a GSE QM anymore. Go back and resubmit with a available and applicable QM type. Next slide. So here's where the rubber meets the road. Joe talked about the new APR calculation for general QMs that impact both the determination of whether it meets or exceeds the higher price covered transaction threshold, which is the safe harbor versus presumption of compliance or rebuttable presumption of whether it's the borrower has the ability to repay. And it also will affect the new price-based limit thresholds that they created in the QM final rules for the replacement of the 43% DTI. So the APR that we're looking at must be calculated using the maximum interest rate that could apply within the first 5 years after the date on which the first regular periodic payment will be due. So let's stop and think about that for a second. So the CFPB wanted to make sure that on common ARM loans, let's say it's a 5.25 or a 5.1 ARM loan with a 5.25 rate limits, that the APR that they want mortgage lenders to use is an APR that contemplates that first adjustment in rate, right? And then you will calculate the APR using that highest rate as if the loan is a fixed rate loan using that highest APR that fits within that time frame. So let's talk about a actual 5.1 SOFR ARM with a start rate of 3%, right? So SOFR ARMs, the index rate is, pretty low, so 0.079. It's got standard margin of 225, and it's a 5.1 ARM, and the limits are 5.25. So at the initial adjustment, so first 5 years after the regular periodic payment, the rate can jump 5 points. Normally, Reg Z has, for standard ARM loans, has a calculation for the APR, which is considered a blended APR. So currently, for a higher price covered transaction threshold, is the loan, the QM, a safe harbor or a presumption of compliance? You use a blended APR. So in this transaction, the blended APR is 3.364. 3.364 does not exceed the qualified mortgage safe harbor threshold, and the loan would pass. So good job. It's a safe harbor loan. Under the new QM rule, this exact same loan, based upon the new APR calculation for this ARM loan, would absolutely exceed the HPCT threshold, because the APR would now, for this test, would be 8%, a little higher than 8%, as you can see. So immediately, this impact is it takes a safe harbor QM and makes it a rebuttable presumption QM. So something to think about when you're looking and if you offer ARM loans. To give you a clearer picture of the comparison, so at the bottom of the screen, you've got the current safe harbor or presumption of compliance general QM thresholds, right? So it's 1.5 and 3.5. The new price-based thresholds, which again replace the 43% DTI requirement, are loan amount based, right? So they vary based upon loan amount, they vary based upon lien position, and they also vary if it's a first lien manufactured versus not. So there is some variation. They do add a slightly larger margin for the price-based threshold, but you'll notice that threshold's still not that high. And it's important to understand that if the loan exceeds the price-based threshold, this is not a safe harbor versus presumption of compliance threshold. This is no longer a general qualified mortgage loan. So the loan falls out altogether. And this would apply to existing general qualified mortgage loans. And since there is no longer going to be a separate GSE QM, it incorporates all of these types of loans into this new price-based threshold. So a very important standard, and one that for certain ARM loans may be exceeded pretty easily. Next slide. So this gives you a better idea of what this would actually look like in the real world. So under the new QM definition, and again, this is for the same ARM loan we're talking about with a start rate of 3%, 5-1 ARM loan, that first of all, because the APR that you use for these two tests is 8% and not 3.3% APR, you're going to have a presumption of compliance for your higher price covered transaction determination for the general QM. Because again, the margin is 1.5, but you'll notice the loan rate is 8, right? The price-based limit threshold, you're going to actually fail for purposes of general QM. Why? Because you're actually exceeding the threshold by quite a bit, because the difference is 2.7. So again, it's interesting, and it's going to be interesting to see what this does to the ARM offerings with respect to how the types of ARM loans that are going to be offered in the industry. Is it going to be a situation where instead of at the first rate adjustment, it can go up to 5, 5 points? Do you limit it to 2 or 3? But even then, I haven't done full-blown testing on that, but even if you did that, it's highly likely that you would still exceed the new QM price-based threshold, which is again a replacement for the 43% DTI threshold. So the new general qualified mortgage loan, or updated general qualified mortgage loan definition, didn't remove the requirements to consider and verify income, assets, DTI, et cetera. What it did do is, again, get rid of the very confusing Appendix Q, which again has not and had not been updated since the final rule was promulgated many years ago. So it had not been updated to reflect the updates in various underwriting guidelines and loan product offerings. So it was definitely stale. And instead, the lenders are guided to use specific external standards like GSE guidelines or agency guidelines for purposes of underwriting and valuation. And again, this is already done to some extent elsewhere in your systems of record, I'm sure, where you receive a eligible or approved from your automated underwriting system. And so more likely than not, you have some form of AUS certification that could be used to meet the consider and verify requirement versus an actual 43% DTI threshold. So these guidelines are in place, and it's just a matter of looking to see, where you need to make some changes, maybe in your origination process and your loan manufacturing process, whether it be policies and procedures or simply the workflow that you have as you move forward. Next slide. So the last thing I'm going to talk about was the seasoned qualified mortgage that Joe talked about, and just wanted to point out at a really high level. So when looking at a seasoned qualified mortgage loan, the question is when are you going to be able to determine whether it is a seasoned qualified mortgage loan. Well, certainly you can determine at origination whether the loan's eligible, right? To someday, when it grows up, gets old enough, can be a seasoned qualified mortgage loan. And what's important to point out is what I did see is an attempt to say, okay, fine, at origination, the loan doesn't meet a general qualified mortgage loan threshold. So it is not eligible for general QM. Why? Well, maybe the rate is too high. So you don't have a safe harbor for the higher price covered transaction threshold. You only have a presumption of compliance. That's okay. You could still be a seasoned QM, maybe. You exceed the price-based limit threshold. So you actually don't meet that threshold either. That's okay. You still might be eligible. The thing is that, of course, is that seasoned QM, to be eligible when it grows up, it has to be a first lien, a fixed rate. So you're not going to run into the ARM loan situation that I talked about earlier with respect to the new APR. But again, I'm still not exactly sure what, as Joe said, what problem this is supposed to fix. I don't know that there's a problem running around out there in this arena. But certainly this is an area where, again, it begs for automation, where we can test for eligibility. And then later on down the line, if a lender wants to determine a loan that has been in its portfolio for at least 3 years, whether it meets the remainder of the requirements with respect to delinquencies, et cetera, then at that point, it could meet the definition of a seasoned qualified mortgage loan. Next slide. So things that you should consider, and this is where I'm going to drag Joe back into the conversation. So the first thing is, with respect to investors, my advice is you're going to certainly, from now until June, well, certainly before July, monitor the guidelines of the investors that you sell to, because they are going to be looking at all of these changes as well, all of these requirements, and they're going to make determinations on what they want to see for purposes of these updates with respect to the replacement of the GSE QM patch with the additional limitations under general QM, as well as potentially the seasoned QM loans as well. And so looking at the guidelines, also maybe reaching out and talking to your investors about it to determine what you may need to do on a go-forward basis to meet these requirements, which then folds into your policies and procedures. So Joe, did you want to talk a little bit about the updating of policies and procedures and where lenders can look for help in that arena?
Oh, sure. Well, thank you, Angela. I think this is the point we want to talk a little bit about a good result for what happened. And by that, I mean, the new QM definition has got two parts. One is underwriting. You've got to have policies and procedures. What are you adopting in terms of the ability to repay? But then the second part is, okay, you've done that anyway. Do you hit the pricing thresholds? And one of the quirky results here is that in the past, if you use the Fannie Freddie underwriting engines and they kicked out the loan saying we can't buy it, it was not a QM, which again hurt the secondary market, or actually eliminated the secondary market. Now, if the only reason why it is not purchased cannot be purchased by the GSEs, it then can become a QM, but for the loan amount, which again goes out the window. And so I think that what this ends up with is, for folks that are using the GSE engines as one of their primary sources of determining QM, it actually helps you, because you get a readout saying, but for the loan amount, it meets our qualifications. It's actually a benefit and it can help lenders going on down the line. Comments on that, Angela?
Yeah, 100% agree. I think it definitely opens up the market, especially, in the states where jumbo loans are more prevalent, like California, or Florida, New York, et cetera. So for those types of loans, which before, couldn't come in under the GSE QM patch, they now essentially, can, as long as, like you said, you get a a good result from the available AUS that's used, in addition to, meeting the other requirements with respect to, again, if it's an ARM loan, the updated calculation. And I guess that, in my mind, is, again, when I started actually practically running the tests, I'm not sure, and I think you raised it in your slides as well, Joe, did the Bureau realize that it was going to impact ARM loans in such a way? I mean, do they hate ARM loans? Because it looks to me like almost every ARM loan is going to hit. I mean, maybe not a 3-1 ARM loan, but the standard is a 5-1 ARM loan, right? And so every 5-1 ARM loan, more likely than not, is not going to actually fall within a QM price-based threshold, because the highest APR, like you said, includes both the highest rate to calculate, not a blended rate, but the highest rate, but it also will include all the prepaid finance charges associated with the loan. So.
Oh, I agree. I mean, and one thing about the secondary market, they're all a bunch of very bright folks, and they're going to figure out what the risk is that's embedded in a loan that is rebuttable presumption as opposed to a conclusive presumption or safe harbor. And they will probably be the ones that are going to be making the determination as to whether or not those loans are going to be saleable. And I think that your comment is correct. For whatever reason, the CFPB has got some antipathy about variable rate loans, and they built in something which may ultimately not be very, very workable if it ends up being a detriment to the secondary market. Because again, you may end up with something that gets kicked above the 1.5%, a non-saleable loan, and will that depress eligible borrowers from being able to get the loan because it's no longer going to be saleable as not qualifying as a QM.
Right, and exceeds the 2.25% threshold, which again is no longer a QM. And
oh right, oh yeah, absolutely.
I think it's I mean, not a poison pill, but it really, I think it's going to impact a lot more loans. Now, granted, how many ARM loans are being made right now in this rate environment? I don't know, but in the future.
Oh well, that depends upon how interest rates move, and it may also impact if the intention is to force people into fixed rate loans, there may end up being an adjustment there to take into effect the lack of the ability to adjust the loan down the line. And so again, I mean, that will end up working its way into the system, and we're just going to have to wait and see what that result will be.
Yeah. Next slide. So who will drive the QM train? And Joe, your answer was probably the secondary market. And that's always my answer too, which is, he or she who has the gold makes the rules. So I definitely think that they will drive it. Dealing with the receptivity to seasoned loans, I mean, what do you have any other thoughts about that, or more thoughts about that? Again, I'm still confused with the idea behind a seasoned QM.
Well, I think the problem with the seasoned QM loan is that you've got to wait 36 months before it becomes a seasoned loan. And now you're outside of the statute of limitations, which means they can't bring a claim. And maybe this is something we can also equate with the litigation issue. And the litigation issue is, if you make a mistake, if you do not have reasonable underwriting standards, someone can sue you for an ability to repay violation, but it's not conducive to a class action. Why? Because underwriting deals with individual borrowers, and it's expensive to do. And you have to do discovery, and you have to figure out what are your underwriting standards used by this particular lender. And when you sort through it, once the loan begins to age, it's really difficult to argue when people have been making payments on a regular basis that they did not have the ability to repay. Are there exceptions? Yeah, there's a few exceptions here and there. There's been virtually no litigation on this issue. So the answer is, make sure you do your job, make sure you have got policies and procedures which are reflected in this new paradigm of separating underwriting, pricing, and cover both bases. And if you are going to be originating and holding, make sure that your underwriting is sound, because I think the seasoned loan thing is not going to be very valuable to people.
And because it's, first lien fixed rate, you're not going to run into the price-based issue, even though you don't have to comply with it. And we have to meet the points and fees test, so you're not going to have a high fee loan. It's really, right, it's just a high rate. It's a high price loan, so to speak.
Right.
Okay. Well, thank you guys for your presentation. A lot of great information there. We are at a point where we can take questions for Joe or Angela. So if you'd like to present a question, you can type that in the questions dialog box that is on the right-hand side of the screen. And we do have a few questions here. So if I can, start reading these off, Joe and Angela, I just invite you to kind of chime in. The first question is this related to the small creditor portfolio option for QM?
No, as far as I'm aware, it didn't change that section of the regulation. So it's the small creditor exception or the small creditor QM types remain unchanged with respect to the final rule. They weren't changed at all.
Okay. Joe, did you have something else?
Sorry, I put myself on mute. I agree.
Okay, so the next question is, does this help portfolio risk management by allowing loans to become classified as QM when they may not have been originated as QM? Maybe allows loans to be pooled for securitizing that might not have previously met QM?
The new rules are effective going forward. I think it's unclear as to whether or not there is a look back. What it may do is it may affect the ability of secondary market folks to repackage loans which have got these characteristics in them, in that if you meet any of these standards, they will arguably have lower risk. But I think that is not a call you can state clearly, as opposed to the secondary market folks decide whether or not you can package old loans and sell them.
And it's going to be 3 years or 36 months from loans that are applied for on or after the effective date, right? Because they can't do a look back. They're not doing a look back for loans made last year. It's loans on a go forward basis. So we really don't know whether these are all going to be considered seasoned QMs until 3 years from now, right?
And the calculation for the new definition of a QM, I don't think is going to be, it's going to be easy to look back and have people comfortable that we can take a chance on it. So I think it's going to be a go forward. Now, whether or not that means a jumbo loan market gets created, that would be a very, very good thing.
Next question, there's been virtually no mention of the sunset of the QM points and fees cure provision. Has anyone brought up this to the CFPB? Is there any other way to fix a points and fees error now, or will the loan forever remain a non-QM?
Well, I will take a stab at it. I think, but I don't think the CFPB is really very much interested in making that that adjustment. And in light of the the changeover in administrations, I don't think that we can anticipate that that will occur.
So test those loans before origination.
So to that point, would there be any point in running the current HPCT APR test if the new general price-based APR test fails? Might have had a stumper.
I don't know the answer to that.
Okay, all right. Maybe we can get to that offline. That caller can email me directly, and maybe we can get to that. Will the HPML test on AMR on ARM loans also be required to use the higher APR calculation, or will it continue to use the blended APR calculation, or will it continue to use the blended APR calculation?
Yeah, so HPML is under Section 35, and it was not modified by the QM final rule in December. So the adjustable rate mortgage and step rate APR that is needed to run the higher price covered transaction and the price-based threshold is the only one where you have to use the highest rate.
Okay. Next question, can you elaborate on the safe harbor? Under the final rule, there are two forms, one meeting the APR, APOR test, and the second for verified requirements. You need to achieve safe harbor in both for the APR test and verify requirements?
The answer is technically you do, but if you do one, you're going to, can you hear me okay?
Yeah, I can, yeah.
I'm sorry. I think technically you may say, yes, there's two requirements, but as a practical matter, if you meet one, you're going to be meeting the other. The verification requirements really relate to adopting underwriting standards that comply with ATR. If you're going to be making something into a QM, you've got to meet the underwriting plus the pricing, which with whatever methodology you want to be using. And so the answer is, I think really they end up being somewhat homogeneous in nature.
Okay. Well, fantastic presentation, you guys. Thank you so much. So much great information. And thank you, participants, for all the great questions, too. Always like it when we're interactive in that way. I wanted to thank you both for your presentation, and to let everybody know that our next MQuack webinar will be on February 25th on the topic of social media compliance. We have Philip Yee from Plaza and Mike Zastapol from Black Knight Secondary Marketing Technologies talking about that topic. So thank you for joining us today. We will have a recording of today's presentation available on our website in the next few days. Enjoy the rest of your day.
Hey, everyone.
Thank you.